Hello and welcome to another edition of Deal Hunter. I'm your co-host, Mitch Flax with Net Equity Capital, alongside Tom Staub, Red Oak. It's always good to see you. Happy New Year. This is our first for 2022.
Yes, sir. Big year ahead, huh?
A lot of exciting things to talk about. And I'm extremely happy to have Greg Berger, who is somebody I've known the last 12 months, was an introduction to me. But Greg, welcome. You're with Avid Realty Partners. I'd love to learn a little bit more about your background, how you actually got into the real estate space. But we actually come from similar Wall Street backgrounds, although I think you're probably much smarter than me.
Not smarter, not more humble. Thanks for having me. Great opportunity. Appreciate being on the show. I spent 12 years as a sell-side equities analyst, sort of writing the ups and downs of the markets, underwriting companies and their financial future, learning economic cycles, sort of studying risk management out in the business world and in the stock world. And so those were all great tools and experiences that I had for a long time. But I sort of had this burning desire to not write about what other people were doing and opine about others' actions, but to do and create myself. And so that was really what motivated me to sort of transition out of Wall Street and into a business role. Wall Street is also, at least certain parts of Wall Street have been shrinking. That was sort of another motivating factor as businesses change and jobs that used to exist don't exist anymore. You sort of have to be fluid and be able to change with the world. I think that's just sort of generally important. That was sort of another factor. But I got to real estate because I felt that was an area where I could still generate investor returns, which is important, while also doing good for our customers, residents, community at large, and maybe eventually work to build something and create something that has utility and functionality for people.
I love it. I think you absolutely nailed it. So you transitioned from Wall Street onto Main Street back, I believe, in 2014. Talk to me about just, maybe some of the first deals that you started doing and what spaces attracted you in the first place.
Sure. So in 2010, I did some fix and flip housing. 2010 through, for the next couple of years, sort of on the side while I had a job. That sort of taught me the little bit of the basics and got my beak wet for more. I really didn't have a clear idea of what my real estate company would look like. We sort of explored a few different things, but I did buy my first multifamily asset in mid 2015. We bought it on an auction site. Now, it's auction.com back then. Now it's 10x.com. I didn't know much about the space, but it was a 95 unit mid-rise for roughly $14,000 a unit. And I just felt it was a lot of building, a lot of bricks and sticks for 1.4 million, and just was eager to sort of jump into it and get to work. I still own that asset today. It cash flows extremely well with that kind of cost basis. We have refinanced all of our money out. Our money, it's me and two junior partners. We put $400,000 out of our pockets into that deal, just the three of us. And 2 months into it, my property manager quit when I was asking for more work than she wanted to do. And so I literally stopped what I was doing on October 1st, 2015, flew into town in St. Louis, where that asset is located, where I grew up, and sat in the property manager chair for 6 weeks myself, being property manager, which was really a formative experience, taught me a lot about the business, has enabled me to sort of relate with current property managers in our portfolio, have a more mutually respectful relationship, but sort of things that carry me forward. That was our first asset. We did one deal in 2015. I think I bought two assets in 2016, and we were just on the sort of, one or two deals a year sort of acquisition plan for the next, 2 or 3 years.
I appreciate that. That's great background information and really kind of what I'd love to jump in. Tom, our co-host here, is really in the space of ground up development and horizontal space. So, buying these value add or property turnaround in the multifamily is definitely something unique to Tom. But I think there's a lot of folks out there who might have started out just like yourself, buying individual properties and kind of building that passive income. But what really makes multifamily an attractive asset, other than the fact that the first investment that you actually made in multifamily was a complete home run and maybe that got you addicted? But for the novice, for the individual investors, what really makes multifamily a space to want to be in?
Great question. I just wanted to say it's passive income if you're an LP. It's very not passive if you're running these deals. A lot goes into the execution, management of the asset, the personnel, the residents, and so on. But if you're an LP investor, it's definitely passive. And the reason I like multifamily is, number one, everybody needs to live somewhere. This is an essential asset class. It was true before COVID. It was even more true during COVID and after COVID, but I think this pandemic has sort of really driven that point home. Everybody needs to live somewhere, and so that's number one. Number two, it's just a massive, massive market, just a huge opportunity to attack and pursue. Number three, it's very predictable and controllable to some degree, as long as you're not grossly overpaying for your assets. Generally, rents go up. They don't go down. It sort of tracks with inflation or a little bit better. Expenses are more or less predictable. And so we sort of have a formulaic understanding of how a deal might perform. Of course, there's some things we don't know. How much does rent grow? What's our exit cap rate and our selling price when we sell? There's a few opens. We can make pretty educated guesses. So there's a lot that we can dial in terms of predictability. I've owned hotel assets where it's not the case. It's sort of a lower risk and strong return asset class. And, of course, there's benefits from ongoing cash flow. About half of our returns in any new acquisition come from cash flow. The other half is forecast from property appreciation. There's bricks and sticks hedge against inflation. There's obviously tax benefits of converting income into capital gains, tax rates. So there's a whole host of reasons, but hopefully that covers
Craig,
much of it.
I would say if I were a listener hearing this, right, I'm probably thinking to myself, well, I want to diversify away from the equity market. It's kind of crazy right now, volatile, and real estate has to be one of the options that they're considering. So within real estate, if I were an investor thinking about, should I go into a fund that manages single family rentals? Should I buy my own single family rental or do a syndication with multifamily? I think some of the things that I would be focusing on, mainly the benefits of a bigger project like yours, is one, there's a risk hedge when things go bad. And what I mean is, if you think about a flip, tear down a wall, you have a $30,000 budget, there's some black mold, well, you're out 10 grand. That's a third of your bottom line, right? You can afford to see your lease rates drop, or if vacancy go up 5-8% and still make your cash flow month over month. And what that means is, when things get bad, you have time to adjust. You're not in a scramble. So the cash flows are more predictable. And I think that relates to the investor's bottom line. That means they have more predictable cash flow themselves, right? And then two, and it sounds like Manchin's not going to allow the tax hikes, which is good. But if we see tax hikes next year or the year after, then I think everyone should be thinking about taxes, right? And the bonus depreciation and cost seg that goes with multifamilies like you're doing is substantial. So I think a lot of investors get too focused on cap rates, IRR, cash flow, but they're not considering the massive tax benefits. So from my perspective, I would say the two main benefits would be the predictability of cash flow and then the tax implications as well.
Sounds good. I totally agree.
I like that all. One of the things I did want to piggyback, because there are obviously, two different ways to go about multifam. And obviously with the compression of cap rates and how expensive it is to get into a multifamily deal, especially in a market you want to be in. You're looking at something in the threes or low fours if you're lucky, and depending on what market. That being said, we are seeing a lot of folks go to ground up development. Perhaps, maybe just give a quick synopsis of why you prefer value add over ground up multifamily.
I think ground up multifamily can make a lot of sense right now. Prices are insane, and I can see the value of building premium product in fantastic locations at a price that you probably couldn't buy it for on the open market. Obviously, building ground up takes a lot of expertise, a lot of time to entitle and build, and a very deep balance sheet to make all of that happen. But yeah, I think building is great. There's also advantages to buying existing assets. Usually you're buying at a discount to replacement cost. You don't have to wait. It's right here. It's right now. And costs have gone up so much. If I'm buying a 2009 asset at a discount, maybe it's not as big a discount to replacement cost as I would like, but it still is a discount, and it's right here, right now, and ready to be upgraded. So there's benefits to both, but you're right. At a certain point, I don't necessarily want to buy a 1980s deal in an okay location for $250 a door. That doesn't make sense. I'd rather do something else. One last comment is, if you're looking in Austin, Texas, for example, sometimes that 1980s build deal is $300 a door because it's in a location where that much land doesn't exist anymore, and it becomes a covered land play, and you're cash flowing, probably limited cash flow, but you're still cash flowing, writing appreciation, and then 10 years from now, 20 years from now, should you so desire, you can tear down some or all of that property and build something totally new and totally different.
Perfect. Yeah, I love that.
Yeah, Mitch, I would add to that too, because it's near and dear to my heart, the ground up. But back to Craig's point here, time is everything in real estate, right? Especially now with the Fed coming out and threatening the 4 hikes this year. We'll see how that goes. But my projects take 9 months to even get the permits to build, right? Then we talk another 12 months for phase 1, 3 years across the whole board. And there's a lot of risk in that. And commodity prices are way more, we have more exposure to the commodity prices, right? Craig has got half his building already there, right? So that cost basis is from like 1980, right? So he's not having to deal with steel and foundation pours and all the craziness of that we have to deal with. Now, naturally, we have bigger margins, but lower margins in his deals equals higher safety in a lot of ways, right?
I think you nailed it, right? It's risk reward, just like with anything else, right? So there's definitely a higher pop, and you've got that immediate cash flow and the opportunity to enhance that cash flow and get up to those market rents. So that kind of brings us to our next segment, which is, what is the best way to actually evaluate these multifamily deals? Specifically, how do you take that lens, that sell side equity research analyst lens, and bring that to the multifamily space specifically? What are perhaps some of the key criteria that you look at?
A lot goes into that. It's sort of taken me 7 years of being in the business to really develop a sense for value. I started out doing a lot of underwriting and still do a lot of underwriting, but it's sort of become more intuitive now. But we look at price per door versus monthly rent. What's our price to monthly rent multiplier? I used to think 100 times monthly rent was good. It obviously depends on if you're buying luxury where your margins are higher versus more low-end product where your margins are lower. That'll affect whether I want to pay 70 times monthly rent or 130 times monthly rent. It's not just based on current rent. It's based on also on prospective rent. Where can rents go if we execute our value add plan? Obviously, we look at price per foot and price per door and relative to replacement costs and construction costs. We look at sort of the underlying dirt value. Is it location, location, location? Is a lot about real estate. Certainly when you're buying higher priced properties or more expensive per door. Is this a location that can continue to grow? We look at a lot of data. things like population growth in the market, job growth in the market. We look at median household income to understand how much our potential customers can afford for certain amenities and upgrades that we might bring to a property. We look at the median home price in the area. How much does it cost to rent versus the cost of ownership? We look at school ratings to understand who our customer might be and whether, top tier schools are something that might continue to be a driver, and over, sort of the overarching theme is I don't want to buy in places that are shrinking. I want to buy in places that are growing. So sort of where are people from California moving to is sort of been an underlying tenet of my investment thesis. We're buying in Texas. We look a lot in Florida, the Carolinas, Vegas, Phoenix, Denver, Salt Lake City. Those are all sort of great markets. We don't own in all of those markets today, but Texas has been a big focus for us. So that's a lot of information. But
Craig, and there's a guy named Neil Bawa who is kind of big in the space of multi. Yeah, Neil. Yeah, you have a very similar approach, and this is what I used to do some smaller syndications myself, and the exact same metrics too, right? The income growth, population growth. At the end of the day, this is a supply and demand asset, right? So more people than supply, and you're probably in a good spot. So let me ask a question on. Obviously, that's more the macro level. When you dig into the financials, and that can be a long process too. But one of the main pieces I think we all go through is the recapitalization process in the end, right? Do you hold it? Do you sell it? When you go to hold these assets, what are you expecting, in 12 to 18 months in terms of your cost of capital?
So I think interest rates are going up. They have gone up some. I think they're going to go up some more, but I think that there's limited room for Uncle Sam to raise rates. We're not going to get 12 or 14 hikes the way we did in 14, 15, 16, 17, or whenever those many hikes happened. We have put out so much debt into the market. Don't get me started on money supply and inflation. We've put out so much money. The deficits are so high. Federal government debt is so high, unfunded Social Security commitments and so on, that I don't think we have more than 4 to 6 raises in us before the government has to stop, the Fed has to stop. To some degree, we're going to see lender spreads thin out. So I think the impact on borrowing rates is less than 100 to 150 bips. And I think some of that bad news is already baked. We've seen, Fannie Freddie rates rise from a low of 3.1 to more like 3.5, 3.6 today. So, 50 bips of bad news is already baked. There's maybe another 50 bips to go, all in, possibly less. That's sort of how I'm thinking about it.
Yeah, so you're looking at a 5 to 7%, 25-year amort, 7-year hold kind of recap, probably.
So in existing multifamily, they're usually 30-year AM. A lot of the folks now are interest only. They want max interest only because who wants to pay down 3.7% debt when you're benefiting from 15 to 20% inflation? Just give it back to investors as cash flow. My investors generally make 14% IRR is what we target in a deal. So if I can give that principal money back to my investors and help them achieve a 14 IRR versus paying down a bank at 3.7%, then that's what we do. But I figure in a year we're probably borrowing 30-year AM from Fannie Freddie at high 3s, maybe 4%.
Guys, let me jump in here and just ask a question before we wrap up ways to evaluate these deals. And I'm also interested, self-serving, but I think our listeners might get an idea of kind of the process that you actually go through and all the criteria. Do you have a specific score sheet or a tally that says, hey, this is a buy based on these metrics? We looked at the market, we looked at, the pro forma, et cetera, check. And now we have this score and that's a buy score, or this is a pass score.
So we do that. We canvass the market of available opportunities and sort of get, whisper pricing from brokers or sellers. And if it's at all makes sense, then we do the next round of work and underwrite the deal, which takes about an hour for one of our underwriting analysts to run it through our model. Obviously, the first pass of underwriting is you can obviously spend the next 50 hours digging into a deal, but an hour is sort of a high level pass through our model. We, convert some of those median income and median home price metrics, and of course, basically assume an exit price 5 years down the road based on income and exit cap rates, and sort of come up with a price that makes sense for us to buy the asset. And if we're within 5% of whisper price on an asset, then we'll sort of mark it as one to track. If we're 20% off from whisper price, then we chuck it in the garbage can. Phoenix is a great market. I haven't been able to participate because I like to make the numbers work, and it's impossible to make the numbers work in Phoenix. Or Vegas is kind of the same way, but other people have a different process. If they like the real estate and they like the dirt and they like the market, they just buy and assume it's going to appreciate and sell for more later. And in places like Phoenix and Vegas, that has worked amazingly well. And if you need the numbers to work and you follow a process like I do, it's very hard to make those markets. That's a little bit of high level on our process.
That's perfect. This actually segues. I'm going to add this next segment in real quickly, because one of the things I heard you touch on, and it sounded like you were alluding to, was ways to kind of, I guess, look for returns to your investor through appreciation. And I think that's a dangerous game to play. I think you obviously can factor that in, but as an investor, if I'm a limited partner, or I want to be a passive investor and reduce, or perhaps I actually want to be an active manager and I want to get some of my friends together and my network to go out and purchase a multifamily, what are some things to look for that are a bad deal? What are red flags, maybe 3 red flags that maybe more so as a limited partner, that if I'm looking at a PPM or some, investor fact sheet of a deal, what are red flags that I should say, hey, okay, we need more clarity around this before we proceed?
Okay, some red flags. I mean, first of all, overall price of the deal relative to the quality of its location and its replacement cost. Age of the asset factors into that as well. Obviously, fee structure is an important one for investors.
What's a normal fee structure? What is something that's fair, and what is something egregious, perhaps, that you've seen in other deals?
I mean, we generally take a 1 or maybe 1.5% acquisition fee. We take 1% of revenues as an asset management fee to sort of pay staff to manage the asset and oversee the property managers. And then we take a promote, 70-30 over an 8% IRR. So sort of typical promote. Sometimes you might have a higher first hurdle. Some groups have a lower first hurdle. Sometimes I see 3% acquisition fees, which is egregiously large. Sometimes we see refinance fees, disposition fees. I like to make a little bit of keep the lights on money in acquisition and asset management fees. And then, we make our money with the promote when we sell, when we hurdle an 8 or a 9 IRR. And if you're just making, if your sponsors are just making so much money on fees that they don't care, that's obviously a bad thing. So I'm really in it with my investors, shoulder to shoulder. I think want to look at how much capital your sponsors are investing out of pocket into a deal. Out of pocket means net of the acquisition fee that they're making up front in the deal. So if they're making $500,000 in act fee and they're only investing $400,000 into the deal, well, they really have no skin in the game. And institutional investors don't like that. That would be a few things. And then, are they in that market? Are they in that asset class? Do they have experience with 70s built deals or 80s built deals, if that's what they're buying? And I'm growing a platform. Those are challenges I've personally had to overcome, and I'm still overcoming. It's a very long road to build a platform and gain a lot of experience. But So those would be a sort of a few things that come to mind.
It sounds like really almost any other investment related business where we are looking at egregious fees or fees that are reasonable for, the returns that are provided. So I appreciate that. I think, our listeners can say, okay, what is a reasonable amount of fees that I should be paying? And a lot of those are baked in. I think a lot of investors are, perhaps aloof to all those different fees that are going inside of a deal, and they just see the overall return number. And so I really appreciate the insight onto that. Tom, anything you wanted to add in about perhaps what makes it 100%. A bad deal?
It's all variable, right? But what I will say is a tip to investors, and fortunately capital has been flowing to us pretty easily, right? And I kind of get shocked sometimes when investors, they give capital based on the salesmanship of the person telling them the vision or idea. And that can be dangerous. And one thing I tell them all to do is, no matter who the operator is, this is really a cash flow business, right? Cash burn business, cash management business. And any reasonable operator will have a month-to-month, probably 36-month cash flow statement. And I think it's reasonable to ask to see that and to say, how are you managing the cash from day one to the end? A lot of these operators go belly up due to poor cash management. So if it were me, I would be asking not necessarily about the vision, which is one thing. How are you managing your cash, and how do you protect against those one-off situations where you're upside down in cash?
That's why I love having you on the show, Tom. So
sorry, Craig.
last thing we want to talk about, and that was perfect. That's exactly what I was looking for, and so I appreciate the insight into that, and I think anybody listening to that would appreciate it as well.
It's a key risk management principle. And something I take with me from my Wall Street days, having survived 08, 09, hiding under my desk. We bring more CapEx to a project than we think we need. We fund it up front. And then on top of that, we're bringing a substantial amount of cash just hanging out on the balance sheet in case you get a tail event risk. That means I'm bringing more equity to each project than I hopefully need. It means my denominator of equity is larger. The overall project returns are a little lower. It cuts into my promote, and that's a insurance policy that I'm willing to pay for and helps me sleep easier at night. A lot of folks don't do that, and Tom, you really hit the nail on the head.
Each project, we're sitting on at least $500,000 to $1 million in just cash. It's just sitting there. That my bigger concern now is not so much our reserves. That's great and healthy. It's more 9-10% inflation, and it's just sitting there in a 0.1% in account. So I'm trying to figure out, well, how can we provide or put it into safe spots to earn interest? So yeah. Anyways,
good luck with that,
Craig. Yeah. You've got an opportunity, and really one of the reasons that we're here today is that you've got an opportunity in our backyard, essentially in Houston, for the 7 Square project. I'd love to learn a little bit about what makes this project so great. And in my initial underwriting, I've got some things to add on, and I think you'll probably hit on them. But tell us about what makes this deal so attractive to you and why you ultimately pulled the trigger back in November to go after this asset.
Sure. So we're buying 7 Square apartments in Houston, Texas. It's in a fantastic neighborhood. It's called Memorial. It's zoned to Memorial High School, which is probably the best public high school in Houston. People move to Memorial to send their kids to Memorial High or junior high. So we like that a lot. The asset is built in 2009. It's 402 units. It is huge. It's a well-built, well-constructed mid-rise wrap product with a lot of scale. This is an institutional sized asset and an institutional quality asset. It used to be called the Alexan Silver. Alexan is Greystar's brand. So they used to own and run the asset before it was sold. We're getting a fair basis on the asset. The asset has been operationally challenged for a number of reasons that I won't get into, but I don't think it really relates to the asset itself. And so there is a lot of upside in terms of value add renovations and overall property cleanup and resident engagement and all of these things that make a community and allow us to improve the financial performance of the asset. So institutional quality, mega scale, fantastic location, great schools, really expensive home prices all around us, a discount to replacement cost, built very sturdy, and a lot of upside meat on the bones.
When you say upside meat on the bone, what are you referring to? Is it the rent rolls? Because when I looked at it, it seemed that the rents were tremendously undervalued to the market. And I physically, by the way, I trust all the data that I see. I trust and verify anytime I evaluate a deal. But I actually went and physically to the website of the competitors of 7 Square and tried to look at the floor plans and book a lease, and actually saw the cost per month. And the estimates in your comps, by the way, were undervalued. So I actually think you even have more meat on the bone than what those current market prices reflect.
Amazing. If you keep it up, you're going to get a job with me. Right. So upside means that the rents in place are probably less than they should be. This is sort of a delicate topic. We don't like to take over properties and just jam the rents. It has to be a yin and a yang, a give and a take, sort of a karmic circle where we're providing value to the property in terms of interior unit upgrades that improve our residents' quality of life, exterior cleanup, and this property does need a fair bit of cleanup and TLC. That's why rents are less than they should be, one of the reasons. But, we don't just come in and jam our residents. It has to be a give and a take where we're giving value, and in exchange, we ask for the same in return. But yeah, we essentially see that our competitors and comps in the market are charging $450 more than this property because our residents' current living experience is what I would call it less than it should be.
That's great. And ultimately, for listeners who are interested in this, we are looking, I think you are looking at institutional partners with the potential opportunity for some smaller accredited investors to come in kind of late in the game for anything that might be left over. I think this is a very attractive multifamily deal in a very competitive space, but it's a prime location. I love the neighborhood, and you are absolutely right. The school systems are highly sought after. Without getting into too specific of numbers, but what could a limited partner expect in, a range of returns for an asset like this, without really speaking to 7 Square, but something like this? What could I expect from a range in terms of preferred rate of return annually, and perhaps a exit multiple?
Sure. So we're generally picking deals that underwrite to 16% gross IRR, which would translate into about a 13.5% net IRR for LP investors, passive investors. That 13.5% is going to be a mix of cash flow and appreciation when we sell. Typically, cash flow in these deals might average 7, 8, 9% over a 5-year hold. Now, within that, you're probably not going to get 7, 8, 9% in year one. Year one is when your yields on the project are thinnest, and you're doing work to improve the asset and ramp the income. And so year one might be, in this market, with valuations where they're at, it might be 4 or 5% in year one, and hopefully by year 5 you're at 10%. It could potentially be better if you're buying a cheaper price point value add deal. You might be able to do better. If rent growth is faster than expected, you might be able to do better. On the other hand, if we hit a recession, it might be worse. And so it's always a long game with multifamily, but generally 7, 8, 9% average cash flow over the 5-year hold, and 13.5% net when we exit. Now, the market's been so hot over the last few years that we've crushed those return numbers, but you can't get unlimited cap rate compression forever. And so we don't forecast 20s and 30 net IRRs like we've achieved on some of our projects. And so we like to be realistic and put out numbers that we think are meetable and hopefully beatable.
Let me just make one quick comment. People get scared of the red, but sometimes the red is part of the plan, right? And again, losses and tax write-offs and tax planning. When you're at that point where you need to have a tax team to offset your gains, losses can be a great thing. I have investors that I work with that were constantly reallocating their investments to capture losses year over year versus the gains, right? So a savvy investor does not run away from losses. They strategically place them in certain years to offset gains, by the way.
So what Tom's referring to is in real estate, you get depreciation to help further shield your income of the asset, which is a phantom expense. And in year one of any project, we perform a cost segregation analysis that allows us to take, a mega big depreciation write-off. So you get to carry those losses back. You get to carry them forward. You offset any other passive income. It's not going to shield your W-2 paycheck income if you're not a full-time real estate investor. But if you have other passive gains and income, it does shield that. And you're essentially, getting your cash flow for free, tax-free along the way. Those are not, hopefully not real losses. Hopefully they're just depreciation.
That's right.
And then down the road, when you sell, you're selling at a capital gains rate and not, a very high income tax rate.
And there will be a step down based on the depreciation that you do take when you ultimately dispose of that asset.
That's right. So your gain is larger because you've written off depreciation. Hopefully that depreciation is shielding your other income. If it doesn't, then you get to recapture that depreciation and you don't pay for that loss.
Yeah, and tax is one topic that makes people sleepy, including myself, but it's really important. And I had Brandon Hall on a conference recently, and I asked them what is the most strategic tax play out there, and these sort of investments that Craig's managing is exactly that. It's more so than oil and gas in terms of the benefit to taxes. So if you're looking for a tax break, tax write-offs on top of returns, it doesn't get much better than this.
Guys, I love this, and Greg, I am so sorry that we kept you here longer than we had promised. If you have a hard stop, you're welcome to get off. But, I've got one more question. But before that, ultimately, if folks are interested in this or any multifamily deals, they can reach out to myself at mflax@netequitycapital.com. Tom, where can they find you, and Craig as well?
Yep. redoakvc.com.
Craig?
avidrealtypartners.com or Craig at avidrealtypartners.com.
Okay, that's perfect. And excellent discussion here. There's something I did want to ask you guys, and just to kind of to finalize all this phenomenal material. But let me ask you your expertise on the valuation of real estate, and perhaps maybe one of the factors that are going into. But a lot of times in the investment world or any financial market, we look at contagion, meaning, one financial market ultimately, spilling off into another. And it's traditionally a negative impact, right? It's one we saw it in the financial crisis where one sector ultimately affected another. If we have that same mindset, what are some of the factors from other financial markets that are affecting real estate prices and the appreciation of real estate?
You start.
Well, contagion, from my perspective, has a negative connotation usually. I'm watching so closely the Evergrande debacle, and I think they're going to screw the pooch here very shortly after the recent need to take down 40 massive buildings. China controls almost 40% of the world's commodity prices. Right. So you think about how that translates into iron ore, steel, even lumber, copper, PVC piping, all the things that Craig and I use to build out our structures. A lot of people are seeing inflation, and I think that will continue for some time. But if we watch the China and Evergrande debacle closely, if that comes crashing down, which I hopefully it does actually, I think we'll have positive contagion in the sense that we'll see cheaper commodities to our projects. Now, we got lucky. China didn't let our banks into that market very much. And so the exposure to the banks in our system is way smaller than it was back in '08. So that's the question, is how much of that collapse may trickle over to the U.S. economy? I'm not an economist that specializes in that, but from the outside, it seems like it's not going to be too much.
In my opinion, the biggest risk to the financial markets and real estate is the Fed and the federal government's fiscal position or lack thereof. The Fed has acted, in my opinion, in a very irresponsible manner. Yes, they irresponsible.
Okay.
They've saved us from COVID with some great actions in early 2020, but they should have curtailed those actions a lot sooner and a lot more aggressively. We looked into this M2 money supply, the supply of dollars out there in the market grew by 40% from 2010 to 2020, which is about 4% a year, 3.5% compound, which is a lot. And then since COVID has grown by another 40%. And 40% growth in M2 money supply from the Fed buying bonds with its accommodative policy, wiring money to Goldman Sachs and Citigroup and JP Morgan, dollars that didn't exist before they pressed the button and hit send. That's why we have 20% inflation right now. It's not 7%. Anyone with eyes can see that food is up 20, 25, cars are up 30, energy's up 50, housing is up 25, apartments are up 25. Where's 7? Nothing that I see is up 7. And it's the Fed. Meanwhile, the leaders in Washington, frankly, on both sides, but one side is worse than the other in terms of spending. They want to give away more money that doesn't exist, the federal government doesn't have, because they don't understand that eventually actions have consequences. And instead of fulfilling our obligations and promises to fund Social Security and shore up that money so it doesn't have to automatically cut payouts in 7 or 8 years, or shore up Medicare funds, the commitments that we've already made, they want to go out and make a whole bunch of new commitments that we can't afford. It's destroying the value of the dollar. And so I want to be in hard assets, in bricks and sticks type of assets as an inflation hedge. And because I hope the federal government can't come and take that asset from me. And so I think, instead of shoring up our financial house, we're continuing to head down the wrong path. And both political parties have responsibility here. So I'm sorry for the political rant, but
no, Craig, I think one tidbit from this for investors listening is that, again, hard assets. I mean, anyone who's owned assets through this period has done very well these last 18 months. Very well. I mean, even things like a Rolex watch has tripled in price, right? I mean, so if you own real estate and any sort of other assets, look at the used car market too, right? It's all gone up. And, so if you're in hard assets, fantastic. If you're sitting on dry powder or cash, that's probably the worst thing that you can be doing right now, letting your cash in the bank. So
that outstanding content. And I will tell you my benchmark for inflation, dog food. They just skimped my 33-pound bag that I buy for my 2 boxer pups to 30 pounds 3 months ago. And then I just got a 10% hike. Ultimately, that's 20%. That is my benchmark for inflation here on out. If anybody wants to debate me on it, I'm happy to take them up on it. Outstanding content. Always love having you on, Tom, as my co-pilot. Greg, I'd love to have you back on here. Outstanding information. And I think you're going to have a lot of success in this 7 Square properties. So with that, we'll see you guys next time.
Thank you.
Awesome.